In this video, I'll cover one of the often misunderstood payroll topics, tipped wages. Tipped employees operate under special federal and state wage rules, and that means that payroll professionals must understand the payroll concepts of tip credit, overtime calculations for tipped employees, state law differences, and reporting and compliance requirements. This topic is tested on payroll certifications and commonly audited by the Department of Labor, so accuracy, as always, is important. In addition, we'll discuss that with the passage of the OBBBA, certain tipped employees can now deduct up to $25,000 for qualifying tips on their federal income tax return. So why do we tip and when did it start? In the late 1800s, tipping became widespread in the United States because wealthy Americans observed the practice of tipping in Europe, where it was a symbol of aristocracy and servitude. After World War I and II, though, tipping fell out of favor in Europe because it reinforced class division, where only the wealthy gave extra money to lower class workers. Instead, European countries adopted strong labor protections and universal social benefits, and wages for hospitality workers are set high enough to live on without tips, and service charges are often included in the bill. In contrast, U.S. employers embraced tipping to avoid paying full wages, especially for workers in the post-Civil War South. Some argue that the U.S. system evolved to make tipping a wage subsidy rather than a reward. As with all things payroll and accounting, we need to follow certain rules, and according to federal law, a tipped employee is defined as someone who regularly earns more than $30 a month in tips from customers. You'll typically find tipped employees in industries like food service, hospitality, personal care, and delivery. Think servers in restaurants, bartenders, hotel staff, or even barbers and spa workers. Lately, the practice of tipping or asking for tips seems to have expanded beyond the typical groups. I've seen the tip screen for other service industries as well, and that practice seems to have become a bit controversial. The Fair Labor Standards Act, FLSA, allows for a different set of wage rules for tipped employees, and those rules come with legal and ethical challenges. The compensation for these tipped employees is often split between a lower hourly base wage and the tips they earn, and that total forms their gross pay. This structure can make payroll more complex, especially when trying to comply with both federal and state wage laws. Let's start with what the tip credit is. The tip credit allows employers to count part of an employee's tips toward meeting the federal minimum wage of $7.25 per hour, or if applicable, the state's higher minimum wage. Under federal law, the lowest cash wage a tipped employee can receive is $2.13 per hour. The assumption is that tips will make up the rest, up to a maximum tip credit of $5.12. That said, only 14 states use the federal tip minimum wage of $2.13 per hour. 12 additional states have a tip minimum wage of less than $5. 14 states are between $5 and $10, and 10 states have a minimum tipped wage above $10. Regardless of what the tip minimum wage is, if an employee's total tips don't raise their earnings to $7.25 per hour, or the state's minimum wage, the employer is legally required to make up the difference. This makes accurate tip reporting and tracking essential for payroll compliance. And employers must also inform employees in advance that a tip credit is being applied and meet all record-keeping requirements. Failure to do so could result in legal and financial penalties. Tipped wage laws are not uniform across the U.S., though. While the federal rules allow a $2.13 per hour tip wage, many states have stricter standards. States like California, Oregon, and Washington, employers must pay tipped workers the full state minimum wage. No tip credit allowed. Other states like New York and Massachusetts permit a smaller tip credit than the federal maximum. These states might require employers to pay $5 or $6 per hour in base wages to tipped workers. When federal and state laws differ, the employer must apply the standard that is most favorable to the employee. This means payroll professionals must stay up to date on the rules in every state where the business operates, especially for multi-state employers. To calculate gross pay for a tipped employee, you add the hourly wage paid by the employer to the tips the employee earns. For example, Danye is the concierge at a resort in Indiana and receives the standard tipped hourly wage for the state of $2.13. During the week ending June 7th, Danye worked 40 hours and received $130 in tips. So we start by multiplying the 40 regular hours by $2.13, which results in $85.20. To that, we add the tips of $130, and that amounts to $215.20. We divide that amount by 40 hours to double check that the employee has earned at least the minimum wage of $7.25 per hour, which isn't the case. Her hourly rate, including tips, is $5.38 per hour. That means the employer must pay the difference, which is calculated by subtracting Danye's hourly rate of $5.38 from the minimum wage of $7.25, and then multiplying the amount by 40 hours, which is $74.80, which will add to Danye's tip minimum wage and tip wage amount for a total of $290. Let's look at this example where the employee works in Michigan. Destiny is the concierge at a resort in Michigan and receives the standard tipped hourly wage for the state of $3.93. The state's minimum wage is $10.33. During the week ending June 7th, Destiny worked 40 hours and received $130 in tips. So we start by multiplying the 40 regular hours by $3.93, which results in $157.20. And to that, we add the tips of $130, and I come up with $287.20. We divide that amount by 40 to double check that the employee has earned at least the minimum wage of $10.33 per hour, which isn't the case. Her hourly rate, including tips, is $7.18 per hour. And that means that the employer must make up the difference, which is calculated by subtracting Destiny's hourly rate of $7.18 from the minimum wage of $10.33, and then multiplying the amount by 40 hours, which is $126, which will add to Destiny's tip minimum wage, and for a total of $413.20. Here's another example which includes the overtime pay calculation. Janie is a waiter at Famous Foods in South Carolina. Janie earns the standard tipped hourly wage of $2.13. During the week ending October 18th, 2024, Janie worked 45 hours and received $240 in tips. Calculate Janie's gross wage, assuming tips are included in the overtime rate determination. So we start by multiplying the 40 regular hours by 213, which results in $85.20. To that, we add the tips of $240, and that amounts to $325.20. We divide that amount by 40 hours to double check that the employee has earned at least the minimum wage of $7.25 per hour, which Janie has. Her hourly rate, including tips, is $8.13 per hour. So now we are ready to calculate the overtime. Janie worked 5 hours overtime, and her overtime rate is $8.13 times 1.5, or $12.20, for a total overtime wage of $61. When we add the overtime to the regular pay, including tips, I come up with a total gross pay of $386.20. California is one of the strictest states in the U.S. when it comes to tipped wage laws, and its rules differ significantly from federal law. First, California does not allow a tip credit. This means employers must pay tipped employees the full minimum wage entirely from their own funds, regardless of how much the employee earns in tips. For example, under federal law, an employer may pay as little as $2.13 per hour if tips make up the difference. But in California, that is illegal. The employer must pay the full state minimum wage plus any tips the employee receives. Second, the tips legally belong to the employee. Employers may not take any portion of tips, use them to offset wages, or deduct expenses such as credit card processing fees. Third, tips are not included when calculating the regular rate for overtime. Overtime must be paid based on the employee's hourly wage, not their tips. And as of 2026, the California minimum wage is about $16.90 per hour, and local jurisdictions may require even higher rates. Employees are required to report tips to their employer, usually by the 10th of the following month, using IRS Form 4070 or another employer-approved method. These reports allow the employer to calculate withholdings and meet IRS requirements. And employers are required to include tips in gross wages on the employee's W-2, withhold income and payroll taxes from tips, and pay their share of Social Security and Medicare taxes on reported tips. Accurate record keeping protects employees and employers. If records are incomplete or inaccurate, businesses risk IRS audits, wage and hour claims, or legal action from employees. Many businesses now use digital point-of-sale systems that automatically track tips, but manual tracking is still common, especially with cash tips. Either way, employers are ultimately responsible for correct reporting. Effective for the 2025 tax year, a new federal income tax rule created by the One Big Beautiful Bill Act, OBBBA, allows many tip workers to deduct a portion of their tip income from federal taxable income when they file their returns for the tax years 2025 through 2028. Under this provision, eligible taxpayers can deduct up to $25,000 of qualified tips annually, even if they take the standard deduction, and this deduction begins to phase out once a taxpayer's modified adjusted gross income MAGI exceeds certain thresholds, generally starting at roughly $150,000 for single filers and $300,000 for married couples filing jointly, with a deduction reduced by about $100 for every $1,000 of MAGI over the threshold. The rule only applies to qualified tips received by workers in occupations that the IRS has defined as ones that customarily and regularly receive tips. This means not all tip employees or tip receiving situations will qualify. Tips must be voluntary, reported properly, and earned in eligible job categories to count toward the deduction. Mandatory service charges and certain other payments do not qualify as qualified tips for this deduction. Also, payroll taxes such as Social Security and Medicare taxes still apply. And since this deduction is a federal income tax deduction, state tax is still required on tip income as well. Tip wages are one of the most complex areas in payroll because they combine wage law, tax law, and compliance risk. As payroll professionals, your role is not just to calculate pay. It's to protect employees and employers by ensuring every rule is applied correctly. From tip credit to overtime to the new federal tip deduction rules, precision matters.